With debt ceiling talks now kicking off, and it looks like both parties are going to come to some sort of agreement, we do have a nice tick in the market. Now, as most of you know, I am a little bit more pessimistic on what's going to come in the next 8 to 10 months. With that being said, I'm going to shock you all. I did start a position in a stock, and I do think I overpaid a little bit for that position. Let's get into it. Trading for a 7 PE ratio in the trailing 12 month and trading for roughly 11 to 12 forward PE ratio, paying out a 4.4% dividend for you dividend lovers out there. The stock we're talking about today is going to be Pfizer. Now, historically, over the last 4 to 5 years, the stock trades between $29 and $40 a share. And right now, I would say it's sitting pretty close to fair market. We're going to go over exactly what's going on with Pfizer. So as most of you know, Pfizer was there to save the day during the pandemic and benefited extremely well, skyrocketing revenue here and obviously skyrocketing the stock price. A company that was doing right around 40 to 50 billion in revenue shot up to $100 billion of revenue, doing over $20 billion of free cash flow. This is a very strong margin. So this is showing very strong margins, obviously tremendous amounts of growth. And what happened is now we're getting a repricing in the stock, which could lend an opportunity to buy if you believe the fundamentals are still strong. Now, here's the knock on Pfizer. COVID shots are now not needed, so revenue has declined substantially, and that's being priced into the stock. Now, the company believes they're going to do right around $67 to $71 billion of revenue and right around $3.25 to $3.45 a share. But here is the kicker. Pfizer is looking to acquire Seagen. They're going to acquire Seagen for $2.29 a share, along with a bond offering. The thing about Seagen is they have a global footprint on remedies dealing with cancer and possible some cancer treatments in their pipeline, which Pfizer is obviously trying to acquire to get some back-end revenue growth here. Now, along with this, Pfizer did come out with some news on a maternal RSV shot that is now looking pretty optimistic for the company. So you have these multiple headwinds here that I think are going to be positive catalysts over the next 5 to 10 years. Now, over the next 1 to 3 years, volatility is probably going to Volatility is probably going to be strong with the company depending on what investors think about this deal. But I tend to think Pfizer is a little concerned that a lot of things are dropping off in their pipeline. They're not going to have as many strong patent products as they normally have. And so they're trying to get some new things in their pipeline. They're investing in their future. Roughly $2.5 billion is going to research and development. And I think we're going to see more M&A as stock prices have depressed. And there is a tremendous amount of biotech that I think is going to consolidate. And I tend to think Pfizer is going to have a pretty substantial opportunity for revenue growth that's really not being priced into the stock. Along with that, I think even if we go into a recession, biotech is going to perform well because we technically need them on a daily basis. And there's a defensiveness to this as well. So multiple reasons why I like Pfizer. So let's get into what I think you should be paying for the stock. Now, when we go over these numbers, I want people to understand that I did actually put Seagen's debt already into Pfizer's balance sheet with no revenue growth expectations. As Pfizer stated, they think they're going to do between $67 and $71 billion of revenue. Well, I went on the low end of this. I have them doing $67.9 billion of revenue, and in 2024 doing $70 billion of revenue. So before we put a multiple on the stock and get a stock price, what I want to do is just compare Pfizer's valuation to its peers. In the trailing 12-month PE, Pfizer's trading for around a 7, while the sector median is trading between 20 and 25. From a gap forward basis, we're looking at a forward PE of 13, where the sector median is basically trading double that. So we can see here that even just before we even start running analysis, that there could be underlying value when we compare Pfizer's to its peers. When we look at a trailing 12-month EV to EBITDA, we get a 6 multiple compared to a 21. And so I'm going to use a 15 multiple here. I'm going to meet in the middle. And basically from every metric, it is cheap to its peers, and especially on the free cash flow basis. But what we also have to figure in is that there's going to be basically a 30 to 40% decrease on top line revenue and free cash flow. So a lot of these numbers are probably going to be more in line as Pfizer starts reporting 2023 numbers here. But we want to be ahead of this and figure out exactly what the valuation should be on the company. So running conservative numbers and saying that basically nothing's going to happen with Pfizer and they're just taking on debt. We're looking at a company here that we could be buying at $29 a share and roughly getting 11% return with an over 4.4% dividend, getting a stock price around $68 by 2031, which is not unrealistic because the stock did hit $61 not that long ago. Let's just say over the next few years, Pfizer is able to grow a little bit better than anticipated. Let's just say 5, 6. So let's just say 5, 6, and 4%. We can see here we get a substantial jump in the stock price going to nearly $35 a share. I tend to think that this is actually about the least we're going to see from Pfizer. I think there's a tremendous amount of upside and not much downside in this stock. Now, I could be wrong here. We could see it dip back into the high 20s, but I don't think it's getting much lower than that. And so while the market has been rallying, a company like Pfizer has been selling off substantially, down nearly 40%. And with the deal going through with Seagen, they believe that it'll contribute more than $10 billion in risk-adjusted revenue in 2030 and potential significant growth beyond 2030. So when we think about Pfizer, a lot of the times we're thinking about this as being a mature company. But with the times that we're in right now and stock prices dipping and a lot of companies going under, there's going to be a tremendous amount of M&A taking place, which could actually send more growth headwinds to companies like Pfizer, maybe a Bristol Myers Squibb, a Johnson & Johnson. But basically your top companies are probably going to have tremendous opportunities to scoop up some biotech companies that are going under because they can no longer fund due to the liquidity crunch taking place. And companies that have free cash flow and strong balance sheets are probably going to have multiple growth headwinds going into the next 10 to 15 years. And I tend to think Pfizer might be one of the more undervalued ones. And that's why I'm taking a look at this one. Hopefully everybody enjoyed that dive in, and we will see you in the next one. Peace.